sure you own more than 50%, at the end of the year, you combine 100% as if you own everything. Problem. You own only 80%. How come you include 100% of assets and liability of an investment corporation? Well, that's why consolidated financial statement must show percentage you don't own, which is called non-controlling interest. So income statement stockholders' equity section must show non-controlling interest because you are consolidating 100%, but you don't own 100%. So percentage you don't own must be shown up in both income statement and balance sheet. This is a new accounting. Fair value accounting is consistent with IFRS for at least this part, investment part, merger and acquisition. This part accounting is almost consistent with IFRS. US GAAP, cost principal, cost, historical cost, we don't use much. So fair value method, cost method, and equity method. This is a fairly new, 8-year-old accounting. Here, there is another passive category in the cost method. So this is a cost method, either cost or fair value method. Now, accounting difference. I'm sure you covered this in prior accounting class. We're just a example of this. Now, for this cost method here, another passive here, cost method here, passive fair value method, cost method. Let's assume ABC invest in XYZ and XYZ net income, subsidiary 80% owned, SN subsidiary net income XYZ is 100,000. S dividend, subsidy dividend, current period is 20,000. So in this case, you own, let's say, 20%. So for this fair value method and a cost method, first cost method. This is a passive method because you don't make any decision. That's why you don't care what you care, but you are not responsible for net income or net losses because you didn't make any decision. That's why it's a passive. You just wait for the dividend. Here, you don't care about this subsidiary net income because you didn't do anything to make the income here. But you are waiting for this, so you will say cash 4,000, credit, dividend, income or revenue, income or 4,000 or investment income 4,000, whatever that is. That's a cost method. Fair value method. Let's assume your original cost of this is $500,000. Your 20% investment in XYZ was $500,000. At the end of the year, this is stock price went up, so your investment went up by 5,000, 505,000. And XYZ report this one. So fair value method, you make same journal entry for dividend. Cash, you got the 4,000, and credit is dividend revenue. Same, 4,000. This is the same. But you will say, I am better off, 5,000 better off, so debit will be first investment, asset went up, 5,000. Here, credit will be unrealized gain from this investment, 5,000. Now, this unrealized gain will go to income statement, current period income determination. How come we never touch net income here? Fair value method. Well, this fair value method include dividend, yes, but then investment cost and current market value is this. If this is the loss, then investment will go here and unrealized loss will be here, right? The other side. We never touch net income because the stock price, the reason why stock price went up $5,000 is because they report net income. That's why we look at stock price changes, investment changes, and make a journal entry, not net income.
Unrealized gain.
Meaning, instead of trusting management numbers, we trust stock market. Let stock market decide. Stock market know quality of this earnings. These guys like the case. These guys fabricate these earnings. They made pinching. Stock price will not increase because stock market know according to semi-strong form of market efficiency. If this is a solid, a high quality earnings, yes, stock price will go up. You are having a gain here. Let stock market decide how much you earn. That's why instead of taking 20% of this, quality of this is you're not capable of enough as an individual investor to know quality of this. But stock market as a whole, they have every information to find out the quality of this earning. So let stock market decide. And this year, $5,000 increase in my investment. So this is a fair value method, which is again, semi-strong form of they are subscribing without saying it. Accounting pronouncement never say we are assuming we are subscribing efficient market hypothesis. I don't think they know they're adopting this view perspective, but they are implicitly using ENH as evidenced by fair value method. They are relying on stock price. That is this. What about this? We all know. Equity, if this is the case, under equity, you journal and your journal entry what? 20. Okay, for dividend cash 4,000, credit what? Credit what? Equity method. Investment what? 4,000. Well, for equity method, you have significant influence over investing corporation, production, financing, operating decision. Paying dividend is a financing decision. Let me ask you this: who decides to pay dividend to yourself? You. Therefore, this is not income. This is a return of capital. It is not income. Under equity method, if they pay dividend, you made the decision to pay yourself, which is return of capital, not investment income. I mean, we have a faculty candidate once in a while they have job interview, and we invite them and make a presentation. Well, they use all these econometric models, fancy models, and then investment income, for example. Here. No. Accounting, under this, dividend is giving investment back, not income. Because you decide to pay to yourself. What about dividend? The net income. This is the dividend, net income. Investment will go up. Investment will go up by how much? 20% of this, 20,000, and credit will be investment income of 20,000. Guess what? This 20,000. This subsidiary, where is this subsidiary? South America. they just have once after you made this journal entry, $20 million investment income. There was a political coup. New military government said single dime will not go out of this country. Happens all the time. Too late, because stock price already incorporate investment income with $20 million. This is the problem of equity method. After recording billions of income, you might not collect a penny cash from this income you report. How much Fortune 100 company will report investment income through equity method? Billions of dollars. That's why this is a really aggressive form of a income record. Cash might not follow. But when you find out cash is not following, that's too late. Because the income was recognized last year before. Major topic here, trading, consolidation, acquisition method. And you already know from your advanced accounting, acquisition method. Major difference between these two, available for sale trading. Anyone could just still remember this? Major difference between these two, accounting wise.
Like the next 90 days is available for sale, and the trading is
Or for sale
longer
right
term.
now. In terms of accounting, unrealized gain or loss, unrealized gain or loss. You still have that securities, but market price goes up and down. That's why depending on the market and movement, you have a gain, unrealized gain or loss. So unrealized gain or loss, this one will go
Income statement,
to income statement, EPS, and this one,
AOCI.
AOCI, stockholders' equity section. That's the big thing. We'll talk about a little bit of it. This requires several sessions, but we'll take a look at for this one. For bond investment, you have one more category, HTM, held to maturity. But for stock investment, you have these two non-HTM, held to maturity for stock investment. Why? We don't have held to maturity for stock. Because there is no maturity for stock. Stock assumes going concern assumption. Company will live forever. Going concern value. So here, this is a summary of what we talked about. I just threw out numbers. This is a summary of this journal entry. Except for the consolidation. We'll talk about some consolidation today. So equity method. Dividend, sales price are cash flow from investing activities. So income statement effect, dividend reduce what? Investment account. Dividend reduce your investment account. Not income. Common mistake. Marketable securities. And I already demonstrate fair value method here. You can simply follow this. Changing asset value to holding mark-to-market accounting. We say this is a mark-to-market accounting. You mark your accounting to the market price. So mark-to-market, fair value accounting, current value accounting, investment classification. Sometimes the available for sale trading, depending upon classification. Then how the original investigation? What is the rule for classification? Can you switch back and forth from one portfolio to the other? What's the rule on changing classification? After you have HTM, AFS, and trading T, what is the rule says about reclassification? Oh, I changed my mind. I will go from HTM to AFS. the other way around, trading to AFS, investment accounting. What is the rule? Colon gap. Come on, guys, you already know. I look at a Beaver Jensen teaching note. What does the rule says about changing portfolio?
Once.
Once?
Whatever this particular security is, if you change it,
Mhm.
it's changed.
It's there. It's
Right.
there. So in which case you can change?
You can change it from held to maturity to available for sale, but then you can't switch that back
Okay.
to held to maturity.
What about AFS to trading, or the other way around, trading to AFS? What's the rule says in general? See,
I think you just can't.
if this is the term, Wall Street Journal use. The reason why they don't allow a change in classification unless you prove and persuade IRS and independent CPA. You have to prove hardship. If I don't go to market and dump these shares, we'll be having major liquidity problem. You have to prove the hardship case. It's just like scholarship. You have to prove your hardship case. Otherwise, school would not give you scholarship. So the reason why we have this brand new accounting, FASB 115, FASB 121, it's already 15 years ago. Over the years, they tightened this rule because 1970s and 80s. Here you have XYZ, ABC, DEF. Let's say the corporation, STI Corporation, for example, STI Corporation has three investment. Cost is $100 million, $20 million, $50 million. Market value at the end of the year is this one is 80 million, 40 million, 80 million, 40 million, and a 55 million, for example, at the end of the year. Usually they have, for corporation, they have many different portfolio of investments. I need about $20 million pre-tax income to meet the target EPS. Before this rule, you don't touch this. You go to market and dump it. If you have 10, 20, 30 different portfolio, then about half of them increase, half of them decrease. This is easy. So you go to this portfolio and say, look, cash 40 million and cost of investment is 20 million, gain 20 million. And this is exactly what you need to post target EPS. In this case, target EPS doesn't make any sense because you can manufacture any earnings per share if you have 10, 20 different investment portfolio. We say this is cherry picking. Cherry picking and gains trade. You trade only gain position. You pick gain position, a investment, and dump in order to meet the target. So they say, okay, now you have, once you purchase the stock or bond, you have to declare your intention. Oh, I will classify this into AFS. Gain or loss is 20 million, therefore we go to stockholders' equity, not net income. You can meet target EPS with this. If this is a trading, yes, this can be. If this is the HTM for bond investment, yes, you can. Only way you can use this case is this. But your intention must be disclosed at the beginning of the investment. Once you declare your intention, you can change it. Only case you can change this portfolio, change is hardship case. If you don't go to market and dump this, if you don't get this 40 million, you will be in a liquidity crisis. You have to prove that to IRS and a independent CPA because of tax implication and because of a financial reporting. Does this accounting eliminate cherry picking? I doubt it. This accounting, at least here, limit the abuse of cherry picking practice in investment accounting section. Other income in income statement, other income, report other income, the gain or losses, but fair value change, fair value in here, reported in income statement, income, and this is AOCI in a stockholders equity section usually. Trading, AFS, holding period, marketable securities, you AOCI went up because this is AFS securities. So total Skype investment $5 increase. So total marketable security asset will go up. AOCI, unrealized gain will be AOCI. So Google footnote, if you look at here, marketable security is 34. See, they have much more than this because all major giant, tech giants have cash profit. In this case, much more than this. Cash equivalent, deferred tax. So cash equivalent and marketable securities, they all consider to be a cash. And this is where they park their cash temporarily. So if you analyze the footnote, let's say for tech giants, I'm sure you will see billions and billions of cash in cash account and marketable security. And we know sitting on cash will damage your ROE because that will put financial liability to negative side, and that's why your ROE will be less than RMOA because negative financial leverage will give you will punish ROE numbers, and ROE numbers are usually benchmarked for a performance evaluation. Fair value gain or loss position. Here, unrealized losses on the average here, gain position here. So gain 840 and loss 30. 2012, well, that was a good year for the stock on the average before they died a while ago. So here, now they have AOCI 538 million to 276 million. So you can see by looking at this how stock market is doing and what kind of gain or loss position they have, and once again, rich implications for a financing side of the Google. Fair value gain or losses, AOCI, Google unrealized gain or loss 810 million is a net amount. Is other accumulated comprehensive income section of stockholders equity section. Yes, that has to be. And I think I shared the research with my students about the this area of accounting, right? Edina Povek research. Remember at the beginning of the semester? Right after this accounting, Edina came to me, quite bright undergraduate student from Budapest, Hungary, foreign students. I want to do independent studies after came over 3 credit each, 2 semesters, 6 credit, 1 year. I asked her to go to Fortune 100 footnote and find out how they handle AOCI, whether they have income or losses. Because FASB gave them three choices: individual comprehensive statement as part of stockholders' equity at the end of the income statement. They have three. Our prediction is this: if they have big losses, they try to hide at the corner of stockholders' equity. If they have a big other comprehensive income, they will brag about this by making separate statement. That's exactly what she found using data. I helped her to econometric test. I'm sure I show you cover page of the journal article of International Journal of Economics and Finance. Big Four doesn't usually hire individual international students. KPMG hired her because not many undergraduate students got undergraduate degree with publication with the faculty. And they like the accounting, the results so much. So they say, okay, as soon as we submit, we'll accept it. You change this word, editorial change. It's about 6 months, over the kind of 6-month period. So Adina, one of the resume item is publication. I sent one copy to KPMG partner. Look, this is my student and your employee. She just got a publication. I think she's in Chicago, doing well. So this area, that we predict using data, we exactly find out their practice. So here, foreign currency translation, unrealized AFS, cash flow hedge. So total 2-year period, 276 and 538 million for Google operation. That's not much. Still, they are disclosing components of this. Cisco, they have gain position here, unrealized gain, unrealized losses, and fair value is higher than a cost. So they are overall in gain position more than $650 million. So good shape. 2000 middle of the 2012. Bond. Now you are adding HTM. Bond can be same investment purpose. Now it is having a HTM. So HTM accounting we demonstrated a couple of weeks ago. The bond accounting, premium amortization, discount amortization. That's the HTM accounting. Doesn't change. That's a good old bond amortization of premium or discount. You like bond accounting?
Yeah, I remember it.
Okay,
That's one of the few
good.
things I remember.
This is one accounting that we never saw any change for the last several decades. Makes sense and follow the logic and there's no need to change, and that is a good older account. Equity, I demonstrate equity accounting. They are using journal entry. So this is explanation for my journal entry. Same, the verbal a explanation of this equity method journal entry. Change in fair value do not affect investment carrying value in equity method. That is not the case with fair value. Fair value method, this will change. So that is the difference. This is here investment, original investment, and $100 income, 30% ownership, income increase, earning increase. Now here dividend, 20% of this, $6 is 30% of this is your cash. Look at here, investment, it's investment, not investment income. So, equity method, you have investment in Mita, this 30% of this is $324. Remember, this one line in Google financial statement represents 30% value of subsidiary. Once again, this one line investment in Google financial statement represents 30% value of this. That's why a equity method, old timers say equity method is using equity method is one line consolidation. Anyone heard about one line consolidation? As opposed to full line consolidation, equity method is called one line consolidation because this one line represents 30% value of this guy. As opposed to full consolidation, we say this is one line consolidation. If someone says one line consolidation, that means they are using equity, and this one line represents percentage ownership in that company. Equity method on ROE, equity method. See, equity method, if you use equity method, what will happen to here? Well, you increase earnings, equity earnings, because debit investment income, credit, debit investment, credit investment income. So net operating here, your numerator will go up because that is net income increase, but you don't include subsidies, target invested sales. So if you use equity, that will overstate net operating profit margins. Yeah. Because your denominator doesn't go up. You don't take a sale because you only take 30% of the income. So this will go up, this does not. So you are overstating. You are overstating net operating profit margin if you use a equity method. It affects both of them. Yeah, both of them. Average NOA here. The impact, we don't include this. Net operating asset, we don't include this. So change not immediately clear in this ratio. Financial leverage. If you look at financial leverage is net operating obligation over average equity. Well, earning will go up, equity will go up, but we don't touch this one because we don't include the invested obligation. So since your denominator is going up, this will be what?
Lower.
Lower. Yeah, lower. Yeah. Overstate, understate, pay, not clear. See? So now reading your ratio, when you compute ratio and interpret ratios, reading ratios will have different meaning now, implication. Depending upon which accounting method you use, the meaning of that equity or cost method is slightly different. Consolidation. This is what? Full consolidation when you own target more than 50%. Now, this, as I said the other day, I think I said this example, but since we are doing consolidation anyway, let me do it one more time. This is a consolidated financial statement. Sorry. This is a consolidated for General Electric. This is about parent company 1,400 subsidiaries. About General Electric. Now, parent company is here, plus number one, group of subsidiaries. Let's say this is a retail industry. 20, 30 retail industry. Subsidiary 2, you say here 30, 40 out of 1400, 30, 40 belongs to retail, and another 50, 60 high tech. S3, then many of financial institutions like retail, financing, insurances, and all other financing institutions. And S4, manufacturing. About 100 out of 1400 is manufacturing. And you name it. You have different classes, different industry combined into 1400. What you are analyzing for class A project is this, not this guy. So, what is the name I gave you for consolidated financial statement?
Fruit salad.
Yeah. You slice and dice and put everything together, and if you look at that fruit salad, everything in here, everything look nice though, colorful. Tasty too. But do you know some of the fruit is about to go bad and disgusting? Not here, don't get me wrong, not here. This is good stuff.
It's just pineapple here.
In other words, about 1400, about 200, let's say, subsidiaries about to file bankruptcy. But if you take 1400 parent company average, current ratio is 3:1. They never have liquidity crisis because current ratio 3:1 here, you compute, you can't have liquidity crisis. Inside, about 200 of them are few weeks away from liquidity crisis. In other words, fruit salad is good, some of them are bad. Now we are analyzing this, making investment decision, credit decision, lobbying decision, all these decisions based upon only this guy because we don't have access to all this. Limitation of consolidation. Who use consolidated financial statement? Long-term investors, long-term credit. Because even if they are failing or successful later on, that is my concern as long-term investors because financial well-being of these 200 will affect this consolidated entity for years to come. That's why long-term financial interest, you have to analyze a consolidated financial statement.
Is there any way to quantify or measure any historical evidence on like contagion within subsidiaries? Like if a certain number of subsidiaries, overall the consolidated is fine, but like 10%, like you said, are on the verge of bankruptcy or whatever,
Okay.
like the overall consolidated corporation is still going to be fine no matter what happens.
That, excellent question. It's just that I guess we don't have research because they don't disclose that data.
And there'd be no way to weight. So one subsidiary may be worth much more than another one.
There's no weighting on this. In other words, out of 14, top 20, 30 will be bigger than the other 1,300 maybe.
Right.
So we don't have data, and if we have a detailed data, yes, we can say whenever this ratio hits to more than 20%, they will trigger the event and they are heading for the liquidity crisis as a whole. We can say that. We just don't have data.
Even if the subsidiaries are well diverse,
Yep.
we don't know how to measure what the tipping point is.
See. Here, this industry might be in trouble, or energy is in trouble. Energy.
I showed you that.
Might get in trouble.
I was going to say about that. I mean, I can't give individual companies, but like
within NRG, you got different segments.
True.
You know, they got a retail side, they got, you know, all different things, and then, but they don't give you the granular level of income.
I don't think anyone really wants to know that.
Yeah, exactly.
I mean, as far as management's concerned, like, nope, don't tell me.
Well, that's why they just diversify.
So
Take
are
it bad.
are you comfortable now analyzing your consolidated financial statement? I mean, if this is the case.
These are gonna be
scratch.
televised
I see a
now.
look going back and forth here.
Guess,
I mean,
guess, Professor Kim, guess what we're doing all wrong?
Yeah, look, let's say
Sorry.
you have analyzing this, analyzing this consolidated, you have 15 page, double page written report without knowing this part. Now you include that in your report as a limitation of using financial statement, yeah, consolidated financial statement, yeah. See, that my teacher has special talent of reading consolidated financial statement. Whenever he reads a footnote, he always asks. Well, I was a research assistant for Greenup for one semester. Whenever he reads, let's say, investment footnote, for example, he asked me to go to library and get a copy of income tax footnote. By looking at interrelationship of financial statement, he has a knack of finding out overall what's going on within the consolidated numbers. This is a special talent. He passed away a few years ago, three years ago. But then everybody says if there is a Nobel Prize for accounting, he's the one to win. Now too late.
Ego.
This is the consolidation. So up front, I want to discuss the limitation of using this data, and then we'll do this. Google fully owned subsidiary, all intercompany balance transactions have been eliminated. Yeah, this one-line sentence here is this. We all know this. Eliminated. Okay. Now, parent company sold a $100 million merchandise, which cost them to a $60 million, and this is the sale to subsidiary. And this happens here. Subsidiary is holding this $100 million, and next year they will go to market and sell this for $200 million. Let's take a look at it. From consolidated point of view, this is the 80% owned subsidiary. From consolidated point of view, these are one company. This $100 million sale, is this sale? This is an intercompany sale, which must be eliminated because you can't sell merchandise to yourself. You can't say you just made a $40 million by selling to yourself. If I change, let's say $20 from my right-hand pocket to left-hand pocket, value of what I have never changed. That's why here, eliminating journal entry, you have to make eliminating journal entry debit sales, so credit sales by parent company, debit sales cross each other out, and credit a cost of goods sold, inventory, 60 million, 40 million, and here 100 million. This will eliminate intercorporate sales transactions. So consolidated financial statement will never include transaction between among consolidated entities. Why? Because from outside point of view, they want to find out net transaction economic effect with outsiders, not insiders. What if you don't eliminate? Well, you are overstating sales $100 million. And that will be major overstate if you don't eliminate. According to a SEC guideline, they must say this. If they didn't, because they hire a lousy accountant somehow, they are in trouble later on. Intercorporate, receivable and payable. You don't owe to yourself, so accounts payable, notes payable, credit, account receivable, you don't receive from yourself. Eliminating journal entry will eliminate intercorporate, receivable, and payable. This is it. And there are many other eliminations. Consolidated equity investment balance with assets and liability which relate, and income report by investor company will say expense to the investor. Well, this is the practice here, now here. Intercorporate investment. Okay. Intercorporate investment, you eliminate right here. You eliminate investment in this company, and this is wholly owned. So 100%, there is no premium, you just pay their book value. Asset minus liability is a book value. So you exactly pay 100% of book value. Parent company say, I have investment 3,000. So you are eliminating a intercorporate investment, a stockholders equity section. So eliminating journal entry for intercorporate investment is common stock if they have APIC and retained earning of subsidiary 100%. Doesn't matter. Over 50%, you always eliminate 100%. Percent and credit investment here 100%. This is 100%. So you eliminate investment 100%. So what it does is this. Okay, I eliminate my investment. I have investment here $100 million. You can't invest yourself, so I subtract. Credit investment is to reduce. I reduce a equity because if you look at balance sheet, investment asset goes up, equity goes up. So if we eliminate this, you have to eliminate this. So subsidiary stockholders equity APIC retained earning will be eliminated because they have normal credit balance, debit, eliminated, asset, credit, eliminated. So intercorporate investment will be eliminated. What if this is a 80%? You pay 240,000 here, 2,400. This is 100%. So you have 3,000 here. You pay 2,400. You are eliminating 100% of stockholders' equity. As long as you consolidate, doesn't matter level of ownership, as long as it's more than 50%. But your investment is 2,400. What is the 600 here? Exactly. See, this is the ownership you don't have in subsidiary. You own 80% of this. 20% is the percentage you don't own. Therefore, for 100% ownership, 3,000, 3,000. But here, 80%, 2,400. You have 3,000 and 2,400. Remaining 20%, which is 20% of 3,600 will be non-controlling interest minus the hurdle. This is the essence of, but this is, you see, you don't purchase at book value. Market price of the asset is different from book value in most of the case, in all the cases, I should say. See, non-controlling interest. In this case, you still eliminate 100% of the stockholders' equity, but you are investing 2,400, so 600 is non-controlling interest. So consolidated financial statement will show non-controlling interest of a 6,000. And intercorporate investment will be always zero here. You never see intercorporate investment in consolidated financial statement because you are not supposed to make investment in yourself. How? You pay more than, well, this is more likely the case because if you're interested in a target corporation, someone else might be interested in that target corporation, and that will drive your bid price up. So you end up paying premium. Premium 1,000. This is a $3,000 book value firm. You end up paying 4,000 because you have to bid out the other rival company. How much you paid extra? 1,000. That 1,000 is classified as a goodwill premium you pay. So journal entry would be here. The original journal entry would be when you let's say you pay cash 4,000. Net asset you are acquiring is what? 3,000. That's the value, total value you are requiring. So goodwill will be 1,000. This is not eliminating journal entry. This is original journal entry. You pay 1,000 extra, and that will go here. And for GE and all these major corporations, how much they are reporting? Anyone who remembers the goodwill number from your company? Roughly. Cisco, how much goodwill you have? More. Cisco. Yeah, how much goodwill they have? At least billion? At least billion? It's over billion. I think so. It's over billion. See, the billion, they are accumulating this individual transaction and up,
I found
and
the
they are
smoking
end up
gun.
having,
I found what we need.
yeah, if you type at Google, if you type Cisco Google, it will pop up right away. Oh, Marley, that's more accurate.
I know.
Good go.
10 billion.
We have 10 billion.
10?
10 billion.
Which company is it?
Toshiba.
Toshiba, $10 billion.
Yeah, right. You got to do it.
Yeah, at least billion, right? At least billion for major corporation. Mo is still looking for it. Oh, 12 billion for a Coca-Cola. 12 billion.
Wow.
A lot of Coke.
It's a lot of coke, guys.
9.7, 10. Who are you?
21,
Cisco?
21
Say you were right over one. You had that
Yeah.
now.
Cisco.
That ain't gonna win, the Price is Right, but.
You didn't go over.
You didn't go over, but
It's like
off
betting
by
a dollar.
19
Good,
billion.
number 21 billion. Why do you think it has that much of goodwill? Just like, Coca-Cola 12
Branding.
and 9 and 2.1.
Merged. So
Given the nature of their business, why do you think they have that 21 billion? Here, the idea is here.
I think I know.
Premium. Goodwill is sum of all the premium they pay. Why they are accumulating that many of that kind of goodwill?
They're acquiring a lot of companies.
Lot of startup companies, right?
Yeah.
If they have a good patent, they're acquired by paying premium. And that premium they pay will go right here, goodwill. Yeah.
Google's a bunch of garbage. Only way should they buy it?
No, Brilop, my teacher, Brilop says waste management. Well, he asked me to go to the library, copy waste management a balance sheet. I copied, and then next time I know he published an article in the Baron. He has a column, and he says that waste management is collecting goodwill like a garbage.
You said that at the beginning. I wrote that down.
But
They weren't happy.
So that's how they accumulate. So adjustment here is eliminate your column. This one will be or just add them up, add the subtract, and this is the financial statement you see. This is the financial you see, and this is eliminating of intercorporate aid transaction. And that's why you must see eliminating corporate
Freaking me out.
corporate fee. Well, we already know this cover this intangible asset like marketing, customer, audit, and contract based and brand assets, and there are many different types of assets, technology-based assets. This one, if you purchase, you can put on the balance sheet. If you develop, no way, because there is an arbitrary computation of intangible asset base. So, in this case, Kellogg allocation of Pringle purchase, for example.
I don't want that shit.
Good, how much they pay? Extra?
What are we gonna do?
Look, 1.3 billion. I mean, for this kind of value, the premium was more than the biggest amount. See, the good premium, your extra payment you make is bigger than any item you purchase. About half of them are premium.
Thank you. Pleasure being person.
Craft, go to craft. If you have chance, look at the craft
They're in
financial
trouble.
statement.
Yeah.
Craft. About 70% of their total asset is retail.
Yeah, because if you don't mind.
70%. Look,
So I can-
if someone showed up at Kraft's head office and they say, let me see your asset, and you say, 70% of my asset is where? Up in the air.
Can I have the hard copy?
Somewhere in the market. Because intangible assets for Kraft, this is food
balance sheet?
processing and food company, and they acquire small brand over time, and their intangible asset is close to 70% of their total asset. Challenge for analyzing. Well, Google is 2.5 billion for a Oracle.
Kraft just
And
shit the bed?
the purchase of 6
Wow, mac
billion,
and cheese.
they pay Google on 2.5. Almost,
They were acquired.
almost, 40%, more than 40% of the purchase price happens to be what? Google premium. They do this when they find out they have a other intangible asset to This is either you develop or acquire technology. This is way to secure your technology. In this case, a purchase of a now Google impairment. Google, you at least once a year you have to evaluate Google to see whether they still have a market value. If there is a impairment, you think the value went down, you have to make a impairment journal entry. Debit, impairment losses, credit, goodwill, intangible asset. Goodwill. What's the rule on a goodwill assessment every year? What's the general rule? At least more than once a year. What is this rule?
It was every 6 months.
At least once a year, but they recommend more than once a year. And divisional basis, department basis, divisional basis, like divisional basis. Division A, Division B, Division C, because each division face different market, so goodwill attached to each division will be different. So they say you need to do impairment test more than once a year, recommend a more than one, and then on a divisional basis, not company as a whole. And that's the rule. See here? This is describing right here. This guy. Good. Premium. What if you got discount? What if the current gap says you got discount? In other words, instead you don't have this. For asset, you end up paying 2,000 because not many companies are interested in this takeover. You are the only one, and here you have 1,000. What is this 1,000? Proportional allocation to where? Allocation to where? All the assets. Which is the gap until 2001. That's a slight old gap. In other words, gap changed, and gap said that is the rule. Non-current assets. You allocate this to non-current assets. 1,000, you reduce non-current asset value proportionally. But here, Mario, it's good that you still remember that. It just comes right out because.
I'm going back to the tax class, but I got half of it right.
Good. Now here, current rule is this. This is gain, one-time gain. You got discount, you got gain. Okay. Is it gain? I don't know.
No.
But I guess they just have accounting, which is similar to. Impairment exam. This 1 million has been current fair market value 900,000. Fair market value net asset invested company is only 700,000. Goodwill consolidated balance sheet is a 7. The 300,000. So here, fair value of total invested, fair value of asset, including goodwill is 7. So total implied goodwill is 200,000, but you are carrying 300,000, so you have to bring this down to current implied goodwill, debit, impairment loss, credit, goodwill, 100,000. So using this example, 100,000 has been impaired. Now, prior to this account, Mario, I guess I think that you remember. Good way amortizing goodwill. Goodwill. What the old rule said is before impairment. Amortizing maximum 4 years, right? Anyone remember 4 years? Maximum. Amortizing goodwill before impairment. This is not that. This is the old account, old. Before 2001. So if you have a $10 billion goodwill, 4 years maximum, 4 years. So this will be what? $250 million per year.
My God.
$250 million per year. Yeah, debit, amortization expense, credit, goodwill, $250 million. This was the gap, before 2001, to the maximum 4 years. They got rid of this, and they allowed it. Who makes this evaluation of this? Man. So how much you record impairment loss up to? Man. But here, mandatory amortization. They gave discretion to management. In return for eliminating pooling of interest. They got rid of pooling of interest. What is the pooling of interest? Remember acquisition method, consolidation, 100% acquisition method. The other method was pooling of interest. You remember that from your advanced account. What is the pooling of interest? Asset. Yes, some school never teach advanced account. I found that it's fine. It's just part of an intermediate account. Really. Anyone heard of a pooling of interest? Yeah, of course. Of course. Many times over. The method we are using here is acquisition method, consolidation. Pooling of interest is you copy subsidiary income and capital onto parent company as if you own it. Pooling of interest method will solve most of the manager's problems in terms of budgeting. Why? All they have to do is locate recruiting target by the end of the year, and through merger and acquisition, you include their net income, retained earning as if you own. So Brillo has a book, big book of Dory Pulley. Dory Pulley. I got my PhD, went up to University of Minnesota, and University librarian asked me to throw out some of the older accounting books. Because I am new PhD, they know which book is good for students. So I went up to the library, and there was Dory Pulley, 1962. This book is talking about how manager misuse or use pooling of interest. This book, case. He said, oh, this is very old account. I can't throw out my teacher's book. No. I think the Congress, U.S. Congress, it has one copy. It's not available. One book it talks about how managers abuse this account. So they got rid of this, and they changed goodwill here to impairment. That is 2001, 14 years. Still we are using it. I don't think there will be any big change in this account. Goodwill write-off. Goodwill write-off. Impairment test what this is GAAP, two-step process. HP, fair value, each reporting unit, carrying value, fair value, reporting, exceeding carrying value. Good is not impaired, yeah, you have both. So, they have impairment charge of 8 billion, 5.7 billion. Impairment of 8, Hewlett Packard, 8 billion charge. This one item, impairment. IPO. Equity method investment here, the account increased by $2.3 billion. 3% increase in the additional paid-in capital and IPO through IPO. And in reviewing our daily case, I say there is a second IPO, which is SIPO, and this is happening more and more often. So we'll see by the way, Dell is preparing to come back to the public once again by acquiring this EMS and the company which is actually bigger than Dell. IPO, Pfizer commercial paper issued this common share. IPO represents 19.8% total new public, new IPO firm, and New York Stock Exchange exceeding consideration over book value was 2.3 billion. In other words, they were getting more than what they asked, and 2.3 billion classified as APIC. Well, control. In other words, you own that much, then you are controlling, so consolidation will be good account. Discontinued operation. I'm losing my voice. Let's have a few minute break. I don't think they are ready for the break, but it's an hour and a half, so let's have a
Did you wake over there?
Yeah, I am. I'm waking up, my coffee, I put water on my face, I gotta keep this. Gotta keep.
Earnings history.
From what I hear, you're up at,
Estimated
like, 3
EPS,
o'clock in the morning. I can't
0.58.
figure out if late or get a break.
actual.
Sleep?
No, I
and
just,
wake up
six.
and
when I
then
come
go
home,
back
I'm done, I'm dead.
Surprise if you're missing it.
She goes through for
The previous quarter. Hold on. Exact same thing happened in January of 14. The estimate was 0.55, they hit 0.59.
I gotta change that routine.
The last 2 years,
We
were sold that there was that
I gotta
wild
try,
swing.
maybe next time I'm gonna try getting up early like
We just gotta
before
find
work
out.
and then doing something.
We know how.
How you doing
No, but I
there?
mean, the specific math.
Oh,
I had
earnings,
to,
right.
she got me to it. I had to Google it.
Well, for 2015, that didn't hurt.
What does Blackboard mean?
Right.
Can you
I
highlight?
sent you the links. It's just that page, so it's Yahoo Finance. I found this thing called Wayback Machine. I was able to find last year's. So this is the last year. Oh, and here's the other thing. This is the current. This is like as of today. Growth estimates. Next 5 years per annum, 12.5%. It's called 12.75. So I just revised under forecasts. Analyst forecast to 12.75% annual per year growth over the next 5 years. So I just changed it to 12.75 for each.
I think we're gonna, but then we will have to adjust the expenses also because there's.
But again, other than inflation, what else?
No, I'm talking about if the growth is gonna be that much,
Mm-hmm.
some of those, obviously cost of goods sold and everything else is gonna be related to that, so
Well, cost of goods sold should just be
a percentage of.
common size is about 63, 64%. So
We need to just, is the formula adjusting all the expenses based on the relationship of the percentage?
that's what I asked Kim about that.
No, we'll take a look at it. and-
Right.
Okay.
All right. So yeah, this very happy I just found that.
Oh.